this is Esther from SuperLuckeee, and today I'm going to be going over some option pricing. So if you're going to be trading options, you have to know the dynamics of why options trade the way they do, right? And the Greeks have a lot to do with how options decrease or increased based on the price action, not only the price action, but on multiple factors. So I'm going to be going over how the Greeks change your options premium price, and hopefully this will make you a little bit more aware of which ones to go for, which strikes to get, and which expiries to get as well. All right, let's go for it. First, there's three types of options. There's in the money, which is a strike below the current stock price. So on the call side, something that's in the money is all of this. So since, let's say SPY is 396, a strike that's in the money is underneath, right, on the call side, or in the money is above the strike on the put side. So these are all in the money for the puts or in the money for the calls. Okay. At the money calls, at the stock price, at the money puts, at the stock price, right? So what that means is basically it's right here. It's right at the money. It's the strike at the money. So this is the money strike, or this is the cost of the current underlying. So the underlying is the stock, and the price of this is 396. So at the money call would be the 396, or pretty much this area for the 397 for the puts, right? Because it's somewhere in between. So as long as it's underneath, right, or above this number for the puts is at the money. So out of the money is where it's above the calls price. So anything from 397, all of this is out of the money for the calls, right? And anything underneath the at the money, which is 396, all of this is out of the money. So your whole point is for your strike that you decide to get to be closer in probability to being able to be in the money, because it's going to have intrinsic value or able to be exercised. There's four ways where you can trade an option. You can either buy a call, right? You can buy a call. You can sell a call, right? You can sell a call. You can buy a put, and you're betting that the price goes down, or you can sell a put betting that the price goes up. So there's four ways, right? You can buy a call betting that the price will go up. You can sell a call betting that the price will go down. You can buy a put betting that the price will go down. And you can sell a put betting that the price will go up. So that's the four types of options trades that you can do. And on top of that, there's something called Theta, or one of the Greeks called Theta, and that's time decay. So no matter what, it's almost like death and taxes, right? You can't avoid time decay. All options premium has an expiry, or like it's almost like that movie In Time, right? They're all racing to live another day. Well, the bigger your theta is, the more life it's taking, or price, or value it's taking away from your options. So all your options are basically on a race to hit in the money, gain higher intrinsic value as you're holding your position. But what if the market goes choppy, right? Then you're just killing time on your options premium, and I'm going to show you how that works. Okay, so here's the shorter term, right? Theta is the time decay. So on this option, it has 59 cents. So that means if SPY does nothing today, then by default, your options premium that cost $1.45 is going to be $1.45 minus 59 cents. So that's going to take it to what? Like about maybe 95 cents or so, right? 95, 90 cents, around there. So if you take that out, just because you waited around the day, even if the SPY does nothing, your options premium by default goes down 59 cents. So that's a lot of percentage, or that's like more than 1/3 of your cost. Does that make sense? Now if you just go out one more day, here's something that's the $3.97. It's $2 here, but now your time decay is 49 cents instead of 59 cents. So even if SPY doesn't do anything, in this case your option goes to about $1.60. Does that make sense? $1.65 or so. So you didn't lose as much. Now the more and more time you go out, let's say we get into Friday. Now the time decay, see theta, it's starting to get smaller. It costs a little more because now it has a little bit more time value. So the further and further out you go, you're going to get higher priced options because it has more time to get into an expected move, right? Remember I covered expected move, but your time decay is going to be less detrimental on your options premium costs, even though it doesn't do anything. So look how smaller it gets again. 20 cents, 12 cents, 9 cents now, right? So that means off a $19 option here now. This is $19. You only lose $9 on a $1,900 option. Versus here on a $145 option, you lose $59 per day. So that's a pretty significant amount, right? So it's definitely worth it to get something with a little bit more time value so that while you hold, you're not going to be hit with such high theta. So this is an exact calculation. So another thing to look at for Greeks is delta. So what delta does is it gains onto your options premium per dollar move of your stock. So whatever the underlying is, every single dollar move up or down, your options premium is going to increase or decrease per dollar what the delta is. So that means, okay, this option, right, is $13.65. This one is $13.65. And if the delta is 44 cents, 0.44, and your stock moves $1 up, then your option increases here by 44 cents. So that means $13.65 plus 44, right, equals, what is that? It's about 14.09, right? 14.09, right? $14.09. Okay. The closer in the money or deeper in the money a strike is, the higher the delta becomes. So delta, you see the closer, these strikes are all out of the money now, right? The closer at the money it becomes, or in the money, your delta becomes higher. And the highest delta you can get is 1. So let's see, let's go out like a little bit more further, maybe to here, right? The highest your delta could become is 1. So that means per dollar move of the SPY, your delta increases your option premium, whatever your delta is. So if SPY moves up $1 and your option becomes here $8 now, for the next dollar move, you gain 53 cents. Now it's, look, 53 cents, right? 53 cents almost. For the next one, you get 55 cents. So into this move now, you get 55 cents, right? Does that make sense? So per dollar move, your option gains what the delta is. So you don't gain $1 per dollar. You gain the delta per SPY dollar onto your options premium. Does that make sense? Okay, so the closer in the money or at the money a strike is, the higher the delta becomes, right? The further out of the money your strike becomes, the smaller your delta becomes. So if you have a short-term stock, right? If you have a short-term option, if your option is short-term here, right? And it starts going down, not only do you lose your price goes down, but when it goes back up, your delta is now smaller, right? So it has to work even harder with less time to increase in value. So this is the risk about short term, is that when it goes up, great, but if it's going against you, to regain what it lost, it actually has to work even harder in a shorter amount of time. So unless you're directionally in the right direction for short term, it's very, very risky to hold the wrong direction. So make sure when you're trading options that you're in the right direction for your short-term options. I'm going to teach you guys a trick about delta. Now, normally a 50.50 delta on the calls or negative 0.50 on the puts is at the money. I'm going to show you what that means. Now we go to a stock like Apple. Okay. Look at delta at the money, pretty much like right in between here, right? 146.71 is right in between these two. So your delta is about 50 right in between here, 50 right in between here. 50, right? Slightly out of the money, 146, 147, right? Almost like right there, also negative 50. But here's a little trick. The further the delta is into the direction of, okay, so here, again, 50 delta right in between, right? So we're gonna go way out to maybe, let's say January. Look at the 50 delta now, right? 50 delta is actually in between the 155 and the 160. Even it's at the 155 on the puts, right? Why is it a little bit out of the money? And here's the trick. The further out of the money on the calls the delta is, the bigger the move is actually going to be. So the more upside there is. I'm going to show you something like NVIDIA. Okay, NVIDIA, I'll show you near term, okay? The 50 delta is slightly just one out of the money, right? At the 235. But look at the 50 delta here. Does that make sense? It's right, maybe $5 to $10 above the current price, right? Maybe $10 actually, $10 above. Here too, almost $10 above, right? So why is that, right? And then this is also going into January. Remember Apple, we only saw about 2 points, about 10 points out of the money. Here we're seeing, okay, where's the 50 delta? Way out here at the 270. This is the trick of seeing how much growth potential is there for an underlying position to move, is how far is the delta compared to at the money. Because normally, here, remember this is the expected move. To get the expected move for any expiration, you add the at the money call and at the money put. This is $49 plus, let's just say about $40, is only $89, right? But look at the expected move. It's $103. Why is that? Okay, let's count. Where's the 50 delta? Way out here, right? So if we get the 50 delta here, which is, okay, 50 delta here, $50, right? $50, $52, and then the $49. What is that? That's about $102, right? What is that? The expected move. So when I look at where the 50 delta is on the puts, that's actually an indicator of how much a stock is going to move based on how, and it also gives you how strong a company is going to be into the future. So okay, 50 delta is way out here in the 260, but the price is only 232. So what is this saying? There's a lot of upside for Nvidia, right? So if you go here, and then we're like, okay, so from here, 50 plus 103 expected move, right? This 103 expected move from the 260 makes it 360, right? 360 shows 0.25 delta. 0.25 delta is normally the normal expected move. Does that make sense? If normally 25 delta is the expected move, if you got 103 plus 232, that actually makes it 332, right? 332 is like right here around, but this has 0.32 delta. 0.32 delta, right? But it's saying it's going to move to here, which is the 360, because we did it from 260, which is the 50 delta from the put side. So this actually has a bigger move than what it currently is for this expiration. So that means these options are undervalued. Does that make sense? So look, 0.25 calls are the strike price where the current price plus expected move is calculated. So if it's, and then negative 25 for the delta puts, right? Expected move for any expiration is an at the money call price plus at the money put price. Does that make sense? Okay, so if we go again, shorter term, we're going to add 25 expected move or 24 expected move from the 50 delta is about 259, right? 259, almost 260, like right in between here, right? 255, 260 is 25 delta. Does that make sense? But if you get this plus here, it's about, okay, 256, right? 256. 256. Does that make sense? It's at the, this is the expected move. Normally a 0.25 delta will give you an out of the money expected move. So when you're trading options, you want to be inside this expected move. Does that make sense? So whenever you're like long term in option, you're like, oh, these are too expensive. These are too expensive. I can't afford these. Well, how far can I go out with the high probability of your strike hitting in the money? All you have to do is look for 25 delta, right? Look for 25 delta and try to get inside this area if you're swinging long to, and then you just like, okay, for every $10 move, my 13 is going to become 15. My 15 will become 17. My 17 will become 20. Does that make sense? Or per whatever strike differences these are. So you can just estimate per strike move how much your option premium will increase just by looking at the options chart to see what the next price above or the next price below is and how wide that strike difference is. Very simple way to calculate it, right? So another thing that impacts your options premium pricing is gamma. Now, a lot of people don't know what gamma is, but what gamma does is it changes the rate of change of delta. So per strike, your delta is changing whatever the difference the gamma is. So your delta is at the money, it's 46, right? And if your gamma is 0.06, that means 46 plus 0.06 is 0.51. Now, if your delta increases your options premium per dollar move of whatever the delta is, the stronger the gamma, the rate of change of delta is going to increase faster, right? So you want high gamma so that your delta increases faster if it's going in your direction, or you want high gamma here, so again your delta increases if you're long a call or long a put, right? Because put gains in delta what gamma is, and your calls gain in delta what gamma is. So here's another example of theta, time decay. Whatever the theta is deducted from your options premium. So example, if you're 1365, okay, let's say 1365 right here, right? 1365 for this strike, and theta is 36 cents, 0.36, your option decreases by 36 cents, right? 36 cents would be 1320. Whether or not your stock increases or decreases in value, the premium will reduce by your theta into the following day. So one day passes, okay, your time decay just starts kicking in. It's a ticking clock on reducing your option premium. So the longer you hold an option contract and it doesn't go into the direction faster than your delta increases your premium, then you're going to be losing on your option trade. So your stock or your position better be going into your direction with a higher dollar move multiplied with delta than your time decay decreases from your options premium. Does that make sense? The deeper in the money your option is, the lower your theta is. So sometimes it's good to be holding long term where you're in the money so that you don't have that much time decay on your options. Another factor that changes your option premium is Vega and implied volatility. Now, I talk about implied volatility a lot, right? You've heard about IV crush. And now, not only does it matter on the short term, but it impacts you in a really good way sometimes on your longer term, especially when you can get a very low option premium price, because not only does it increase by delta, but also because the Vega and implied volatility difference. Now I'm going to show you something on the short term versus the long term. Now let's say you're trading short term, right? Like, okay, from this time, it was a little bit short term. So in this case, the 45 strike, right? The 45 strike had a $4 or on average price with a 147% implied volatility, right? With a 4.04 Vega. Now, the next day, if it goes up to 100, here's the 45 again, and it went up to 169 implied volatility, that's a 22% change, right? With the average of 0.05 Vega. So what you do is you multiply these two together, 22 times 0.05, and that equals $1.10. Now $1.10, if it goes up, means it also adds onto your options premium. So your $4 adds onto, or the $1.10, 1.10 is added onto the $4. So that brings it to actually what? 22.05. Stock price difference is 51.39, right? It's 12. Well, the 12 times the delta of the average of these, right? Because 45 moving into 51 is a $12. 12. Now you get the average of these deltas, and all the dollars it moved, you get the average of the delta. That means per dollar move, the average is actually about 0.55 delta, right? So if you get this average and you multiply it by 12, that's $6.60 gain on your option premium just on the delta. Well, your $4 option that you paid for increases in not just the delta, but also in the Vega and implied volatility increase, which was that 110. So your 4 plus 110 plus 660 equals 1170. So this is the power of options, how Vega, implied volatility, and delta can all help you in trading, right? If you can do this on the short term on earnings and you get like a huge increase, that's where we get these fast multiplications. But let's say you don't want to play these like risky short term. I'm going to show you how you can make a lot of money on long term swinging, because if you look at short term versus long term. Now, not only do you get less theta, right? Less theta. But look at the Vega. Your Vega also increases, right? Your Vega gets higher and higher and higher the longer term you go out. So imagine when you buy something very, very low. See the implied volatility? The implied volatility here is only 49.50%. Then as it gets closer to the expiry, it naturally increases, right? So when you buy something with really low Vega, really low implied volatility, and it starts increasing as it gets deeper in the money, right? And it starts getting to 100%. Let's say it goes up from 40%, 45%, and it starts going up to 100%, 200%. That's 150%, right? All of that move. If it gets really deep, 150%. If Nvidia goes from 240 and it makes like $150 move, that would actually bring your implied volatility all the way down to where the 100 strike is, right? That's like 200%. That's 150% change. Now, if you multiply that with the Vega, this on average, I would say is about maybe 15, right? 0.15 times 150% difference. That's a pretty big change. So when you have $1, 1.25 now Vega for here versus way up here, does that make sense? So if you get a long-term option, a January 2025 option with a 1 Vega, and it moves deeper in the money, let's say just 100%, right? If it goes up to 100%, so if this becomes 100% and you're still holding it, it goes deep, deep, deep in the money, and not only does your option premium increase on what the delta is, but it also increases with Vega times the IV change. So 50% change times, let's say this average, even if it was at 1, that would be $50. That's $5,000 on your long-term option as it increases in implied volatility. Does that make sense? So if you get something that's out of the money, that's 45%, and then as it gets deeper in the money, it goes like 65%, that's 20%. So 20% with a total average Vega of 1 is $20 on top of, let's say, a $30 option makes it $50, plus the delta increase will continue to add onto your options premium. Okay. So short-term options versus long-term options, Theta versus Vega. So here's a little cheat sheet. You can just keep this in mind. Both sides, Theta is higher on the short term, smaller in the long term. Vega is smaller on the short term and bigger on the long term, right? The further expirations have lower Theta, further expirations have higher Vega. So here's a scenario of how delta and theta works on short-term weekly options. Now let's say first day. A lot of people get, okay, it's Monday, we get a weekly option, right, for Friday expiry. Well, here's what's going to happen if it doesn't work. Okay, so day one, Monday, you get a stock, it's $100, you're like, okay, I think it's going to go up $5. So you buy this option, it's at the money with the 50 delta, and it costs you $5, right? And you're like, okay, it's going to go to 105. So you're waiting, oh, it doesn't do anything. And so what happens? But then your theta was 65 cents. That means by day 2, even though the stock doesn't do anything, your $5 loses the time decay, the 65 off of your option contract, which makes it $4.35. Even though the stock didn't move because theta didn't theta is like death in taxes, right? Taxes, you can't avoid it. So theta, you can't avoid it. You can't avoid time decay. 1 day passes, your option loses whatever the theta was. Now, another day passes, so theta becomes higher and higher and higher as the day goes by. So day 3, your stock drops $95. And what is it now? Because it dropped 5 points, your delta is now 45.45. And it's now further away from your strike, so it becomes smaller. But not only that, your theta increases to 0.75 because you have less time, right? Wednesday, by the way, is the worst time decay on all the options. So your contract that was $5 lost 65 the first day to 435. Now it's losing 75 the second day, another 75, which brings it down to $3.60. But not only that, your delta, which every point, every dollar move, your option loses on whatever the delta was, right? So if the delta was 0.45, you multiply 0.45 times $5, right? And you subtract that also from your options premium, which is $2.20 in this case. So 360 minus 220 equals 135. You're like, oh shoot, my $5 just became $1.35. You're like, oh no, what do I do? Right? So you're just like holding on to your life, like, please make this go up. Thank God. Next day, it goes back up, right? It goes back up to $100. Yay! But you know what? All this time decay just killed your options premium, because from that, okay, your delta, first of all, just got lower, right? So it has to work even harder to recoup what it lost. But not only that, your theta also increased again to 85 cents. So now your contract is worth 135 plus, yay, the $5 you gained back, which is the 220 you gained back, right? Okay, it's 355, right? But then now your time decay also kicked in again. So 355 minus 85 is 270. So what you paid $5 for, even though the stock is back at 100, what you originally paid for 100, right, is almost like not even, it's like almost half the price at 270, because the stock is at the same price when you first bought it, but there's so much time decay, right? So now it's day 5. Today's the expiration. Okay, your theta is now 95. The cost of your option premium is only 270. So basically all day it's gonna just decrease. Now, not even that, your probability becomes lower. So going into the next day, you already started off with a loss, by the way. So you're 270 into the next day here. Your 270 starts off at 175. Right? It starts off at 175 because you just lost more time decay, and depending on, is the stock opening up or is it opening down, is going to determine, okay, does it become worthless into the end of the day? Because all day, let's just say it just chops around doing nothing, then into the end of the day, the probability of your option going in the money becomes smaller and smaller and smaller and smaller. And for your option to be valued worth anything, it has to be in the money. So on Friday, when you pay for like, okay, $1.50 option, thinking, oh my God, it's going to be in the money. But you know what? That probability is not there. By the end of the day, it goes quickly to zero, being worthless. So you have to be a little bit careful here on weekly premiums, because theta will kill you. And then probability will also kill you. Does that make sense? Okay, we're going to go back to last week on before NVIDIA earnings, okay? When the price was 211, back to February 3rd, right? February 3rd, and right, February 3rd, right here. Okay, so it's about 211, right around here, right? And we're thinking, hey, it's gonna go to 225 to 230. I kept saying it's gonna go to 225, 230, right? The 225 to 230 into earnings at that time, for earnings, I wanted it to be into the earnings week, which was into February, at least 24th week, right? It was showing a 25-point expected move. Hey, what do you know? Where's the stock right now? 236. 236 was pretty much the expected move, right? That's a tip. Okay, so 236 was the expected move a couple weeks ago. It said it's going to get there. So I kept telling everybody, hey, it's going to go to 225 to 230. Make sure those are going to be in the money. Get those strikes, right? So we all got to make money. But if you go to analyze, right, we're like, okay, how much does it cost? The 220, 235, 225, right? So we'll just get the 225. During all that time, we're going to look at the time decay, okay? So this original, $6.50, $6. So we'll just go up one more day. Okay. Now it's February 6th. The 225. Oh, okay. Price, okay, it's around $6 still. The 225. Okay, it jumped up to 10 because the price jumped up, right? So you get all that delta increase, right? It jumped up 10 points. So 10 points times about 50 delta is about $5, right? The day before, what was it, $5, $6, plus the delta increase, right? This averages, let's say, about 45 points actually. So you gain about $4, right? Which makes it jump $4 because it moved 10 points times the average of 40 delta, because all of these together averages about 40 delta, and you add $4 onto your original options premium, making it $10. Now the next day, what happens? It keeps going up, right? It went up $2. Okay, $2 with 50 delta, right, is about another $1, right? So that's why it went up another $1. Now it dropped $10. So $10 with another 40, maybe about 40 to 50 delta, is about a $4 to $5 decrease from your $11, right? Which makes it $6. Okay, now it goes up $5. Do you see this? $5 with the delta on that 225 is about maybe 35 delta to 40 delta. So 5 times about 0.35 makes it about $3, right? So that $6 becomes what? $8. So next day, it jumps up, right? It jumps up to 230. So does this make sense? So it keeps bouncing around with the delta, right? And the time decay is slowly, ever so slowly chipping away at your option premium. But do you see the implied volatility increasing? That's what's keeping the price up, by the way. See how the implied volatility increasing? As it gets closer and closer and closer, implied volatility keeps adding on to your options premium. So you, that 10% plus that 10% change times 0.09, that makes it like 90 cents, is countering the time decay. Luckily, this is increasing to offset the time decay. Now imagine if implied volatility is decreasing, your option premium would be feeling the time decay. But into the earnings run up, the implied volatility actually hedges against the time decay as long as it's going up on the short term, by the way. So again, implied volatility, this is the day of earnings, right before. It's 2:06, I'm like, all right, let's get the 225, right? I said, let's get the 220 to 225. Now the implied volatility is so high. And it was only $2.50 because the price dropped, right? So the delta, boom, dropped. Major options premium drop. And then next day, what happens? It skyrockets on earnings, right? To 236. Where does the 225 go? All the way into $12 again. Isn't that funny? It goes back to the price it was because of the time decay. So, like, even though it went to 236, it goes back to the price as it was when it was 221 a week ago because of time decay. So time decay is not your friend unless you're selling premium. And always remember, make sure the direction that you're going in, or there's a big catalyst that's going to increase your options premium. So timing is very important. And if you're planning to hold long, your implied volatility increase will offset your time decay, which is very small anyway on the long term, but it will multiply with a bigger Vega to add on to your options premium as well as the delta. So I hope this helped with you guys understanding the pricing of options, what to look for. Remember, 50 delta is your friend on the long term. Always look for 50 delta for growth stocks because it's going to help you realize, hey, this is a little bit undervalued. It has all this room to move, and the negative 50 delta on the put side is here. So you can add the expected move from negative 50 delta and get a much bigger expected move on the long term than where the 50 delta is on the short term. So good luck, God bless you, and see you in the next video. Bye.